I'm Lynette Zang, founder and CEO of Zang Enterprises, and we believe in sound money, in constitutional money that holds your purchasing power when every other system is set up to rob you. So let's go back, because we got to talk about what's going on with the FDIC and all of that, because people, they're lulled into this false sense of security thinking, well, my money is insured. Well, first of all, not your money. When you loan it to the bank, when you deposit it in the bank, you have loaned it to the bank. Do not ever, ever, ever lose sight of that. Because as many of you have probably experienced, when the bank says no, you have no choice. So we want to be diversified in there. But, there have been some issues that have come up around problem banks and the deposit over their insurance. Let's just jump right in and talk about that, because the FDIC notes more problem banks sparked debates over the deposit insurance, and going to the most current FDIC diff report, which is about how much money they have in their kitty to pay you off if the banks go under. Well, for one thing, let us not lose sight of how underwater the banks are in unrealized losses inside of the system, because when they raise those rates, the market value, they probably said oops too, frankly, but the market value of all of that debt put them underwater. So even as the central banks start to pivot and lower the rates again, it's going to be too little, too late. You better be prepared for it. And the other part is that the number of assets, so the number of those deposits and all of those gambling, that trading wealth in the banks, the number and assets of banks on the problem list is growing. That's not going away. If you think the problem with the regional banks is solved, well, there's this bridge in Brooklyn I'd like to talk to selling you, but don't believe the lies, because how many times can you be lied to when you don't know the truth? Let's take a look at it, because I think that the Fed pivot is too little, too late. And besides that, the only thing they have is doing it again. Dropping interest rates to zero, printing money. That's the only tool that they have. But here's part of the problem. The FDIC wants a closer look at the $8 trillion in uninsured deposits. Because of all the money printing that they've been doing since 2008, and the money for free that they've given all of these corporations, there is now so much uninsured new money in the system. Keep in mind, every single time they do that, the value of all the money that's out there declines pretty substantially, but those uninsured deposits puts your insured deposits at risk. And you don't even realize, because perception management makes you think that those are your money and you can have it anytime you want. Let me know, right in the comments. Give us a thumbs up, but let us know in the comments if you've had any issues with the bank saying, no, we're not going to send your wire. No, we're not. You can't make that withdrawal. No, because I've even experienced that, and they're getting more and more brazen. But a bank's liability structure can reflect its risk-taking behavior, and information about an institution's funding base is important in evaluating liquidity risk and interest rate risk. Yep. And the liability to those uninsured deposits, which they call hot money because it can move in and out quite quickly, versus sticky money, which is your money, right? So we're looking at corporate deposits versus your deposits. And that hot money makes your sticky money at risk, like we saw in Cyprus. When we saw the hot money flow out of the system, And the sticky money, the depositors' money, just stay in. Made it so much easier to just take away. And by the way, if you do not have a sound money strategy in place, click that link below, give us a call, or hit that QR code. This is so important that you get it done ASAP. When uninsured depositors took a loss, the losses were 24% from 92 to 2007. So there were definitely times when depositors, uninsured depositors went away. But of course, that was before all of the money printing from 2008. The FDIC said this. In contrast, from 2008 to 2022, uninsured depositors took a loss of only 6% of failures. And when they took a loss, uninsured depositor losses were 43%. But really, uninsured depositors between 2008 and 2022, only 6%. Now think about what happened with Silicon Valley Bank and all of those regional banks and the most recent banks that failed. They paid the uninsured depositors. Why would they do that? Maybe because they weren't quite ready for you to realize that your deposits are at risk. And they don't want to create that run by letting you know the probability of it. The FDIC report and call for input from the financial services industry come at a time when there has been a spate of cease and desist orders against non-bank, typically digital-only firms on the grounds that they had been making false and misleading statements about deposit insurance coverage. Remember Synapse? We've talked about that. So here's an update for you on that. So no, Evolve Bank and Trust has not yet released funds for those deposited through Synapse Technologies. So all of these fintech companies that partnered with banks so they could say your deposits are insured. Well, there is, as of August 22nd, nearly $160 million in funds that were still frozen for fintech users. A status conference on the ongoing Synapse bankruptcy did not offer much hope to end users whose funds were still frozen. The funds have been frozen since May 11th. Now, if you have all of your wealth in there and you have to pay your bills, I'm thinking you got a problem. That's why it is so critically important for you to hold sound money out of the system. And part of the strategy that we execute, the sound money strategy that we execute here at Zang Enterprises, is built in layers. So if something like this happened to you, it doesn't have as big an impact because you have real money, even cash money, outside of the system. They can't lock it down. But the goal is to get you completely inside of the system so that they have total control over you and your choices and your actions. And if they don't like what you're doing, or if they make a different choice, boom, you are SOL. We saw that in Canada with the trucker strike. This is all in the setup, and they always use convenience. Sure. How convenient is it for you to hold all of your wealth on your phone? You want to buy something, boom. Except when they say no. Then it's not very convenient at all. And they don't really talk too much about it, but we've got a whole bunch, up to what, 10 million people that are looking at having their money frozen still from those fintech companies. But I really wanted to hammer home that all of this problem started from all of this money printing. And if you look on this graph of uninsured versus insured deposits at all FDIC insured institutions, which, by the way, the FDIC was born in 1933 when we had all of those bank runs and were in depression. And what you see is that while it took a minute for it to really kick into gear, Look at when that shifted. 2013. QE free money started in 2009. This money has to go someplace, and it's been going into the stock market and the real estate market, those markets that have been targeted in reflation. But then you reach a tipping point, and you can see where the uninsured deposits now went above the insured deposits. And it's all from this free money, but of course they don't want you to realize it. Central banks never, ever, ever look in the mirror and go, oh, we caused that. No, but they cause a lot of what they call unintended consequences that puts everybody's deposits at risk. And this is getting worse and worse and worse. What are you going to do about it? Me? I'm going to have a level of real money, sound money that's outside of the system, as well as cash and all of these layers of barterable wealth. Because when the banking system shuts down, what will you have to work with? You better have something, and it better be out of that system, because all that free money has to go somewhere. And that's why you see elevated stock prices and elevated real estate prices. And it's all about, and this huge amount of uninsured deposits. This is all about perception management and wealth transfer. And you know what they have to insure those deposits? Well, there's the diff reserve ratio. Now, I just went in and pulled this. They haven't updated it since March of 2024, right? But even then, what did they have that was different? Well, they have another 2 cents, or not even 2 cents, I'm sorry. It's a fraction, 2 fractions of a penny. So what in reality, when you're looking at the balance that they have for these insured deposits, forget the uninsured deposits for a minute. For the insured deposits, they have a teeny weeny bit more than 1 penny for every insured dollar. There is only $125.3 billion in their diff account as of 3/24. Why hasn't that been updated? Because the quarter closed in June and they still haven't put out a new report. I think that's interesting. What do they not want us to see? Because here we are in September. That should have been updated in June, but it wasn't. Okay, so in reality, what you're looking at is there are more uninsured deposits than there are insured deposits. But if there are multiple bank runs, they ain't paying you out because the money is just not there. I encourage you so strongly to become your own central banker and to create a global movement where you're converting the fiat garbage into sound money that's outside of the system. Is it a little bit less inconvenient? Yeah, but just how inconvenient is it when you can't pay your bills? When you can't buy food for your table? When you can't put gas in your car? Because none of your cards work and none of the wealth that you're holding on your phone works either. That, I'm thinking, is a little bit more inconvenient than figuring out where to hold your gold and your silver and your cash. Give me that inconvenience. Because 1 cent for every insured dollar, okay, what we saw in 2008 was, as long as it was an orderly implosion of a bank, no problem, they could come up with it. But that wasn't really what happened in 2008. And it got to a point where the FDIC actually said, if even one more small bank fails, it will be noticeable that we have no money left to pay this insurance. You don't want to be on the receiving end of that. I mean, you do whatever you want. But in the most current report, liquidity risk for exposures to uninsured deposits, because this does impact you even if you don't have more than $250,000 in the bank. Here is this huge long list. And what we're looking at, 97 banks have uninsured deposits at or over 50% of total deposits. That's when they're most risky. You can go online, you can click the link, you can go and see which banks those are, but you got 97 banks with uninsured deposits at or over 50% of deposits. Now what they're saying is banks reporting a ratio of uninsured deposits to total deposits greater than 50% are at an elevated risk of a run by those uninsured depositors. And that's what created that regional bank implosion, right? It wasn't really the insured depositors, it was all of those uninsured depositors, and that put those that were within that insurance area still at risk even more. And what about banks' exposure to risk from commercial real estate? Well, my goodness, any ratio over 300% is viewed as excessive exposure to CRE, and it's 300% of their assets, by the way, which your deposits are classified as their assets, which puts the bank at a greater risk of failure. And here we have 63 banks that have real estate exposure greater than 300%. And here's the real problem, because it's not just the 97 banks or the 50 or the 63 banks. It's the fact that all banks on a global basis are incestuously interconnected. So this will have an impact. And oh, by the way, that liquidity risk, you'll find all the big banks on there. JP Morgan and Chase and Wells Fargo and Bank of America, and take your pick. Follow the links, go in and take a look at these reports, and you're going to see that everyone, including you, are at risk for whatever wealth you choose to hold in the banking system. And of course, there is a level that you have to hold in there. Maybe you have auto deposits and auto withdrawals. And of course, if you're like me, I'm running a business, I have to pay salaries, I have et cetera, et cetera. But you balance that out, right? You diversify your portfolio so that if you lose access to what you have in the FDIC insured banking system, it doesn't kill you. It doesn't hurt you. It is inconvenient. It is awful. It is all sorts of things. But it doesn't cut you off at the knees. You have a strategy. Click that link. Take a picture of that QR code. Talk to us. Get your own sound money strategy in place so that when that happens, it doesn't cut you completely off. You can still do all the things that you need to do. If I needed to pay my employees in gold, I have the ability to do it because of my emergency gold. Booty, hooty, Rudy, Manooty, because I care about my employees. I want to make sure that no matter what happens, they can get paid in a form that they can use. So we have, we do a lot of business strategies as well. And we have part of that as the strategy. You need to have it, because what we're looking at is that gold absolutely provides that downside protection. If you are locked out of your accounts, you have emergency gold, you have emergency silver, you have physical cash, you have other kinds of cash as well. So that it might be a little bit inconvenient for a minute, but it doesn't stop you like all those people that are still waiting for funds from Synapse, that held all their money in there because it's so much more convenient to carry your wealth around on your phone. There are many reasons why they want you to do that, and we've talked about them. But I just want to stay in here and stay focused on the danger that you are running if you keep all of your wealth in intangible form inside of their system. Because the reality is, and I say this all the time, and you're going to hear me say it all the time until it finally hits home, if you don't hold it, you don't own it, and your perception means nothing in a court of law. In 2008, nobody went to jail. Well, some protesters went to jail, but none of the banks, none of the people that perpetrated what should have been absolutely illegal went to jail. And by the way, what they did with all of those derivatives have gotten even worse. If you haven't just watched the piece that I did recently on, what did I do it on? Let's see. Oh, creditor versus creditor and how they are cannibalizing each other. You need to watch that. That's something I've been talking about for a number of years because they just took the risk over here and they made it a whole lot bigger over here. And you haven't seen the explosion. In 2008, it was the explosion of this itty bitty bit called CDOs. Now it's grown exponentially and it's much, much bigger. And that, no doubt whatsoever, can easily take down this entire system. So we're looking at, since 2008, how has gold performed? And this happens to be in Switzerland, which a lot of people think is like the safest financial system in the world. Used to be. And that's because Switzerland was the last country to go off the gold standard in 1978. So a lot of people, their perception is that the Swiss franc is still backed by gold. No. But taking a look at this, we can see how equities, government bonds, and gold has performed since 2008, and definitely it provides a lot of downside protection no matter where you are in the entire world. What do you want going into what we're dealing with now? You want to keep all your wealth and intangible inside of the system? Good luck to you, as my mom would say. Not me. I want a sound money strategy. I want sound money that's in my possession outside of the system, along with cash. I mean, the strategy is based on layers. And so you want to be prepared no matter what is happening. So if you like this, please give us a thumbs up. Make sure you leave a comment and share. It is critically important that we build this channel as quickly as possible to get this word out to as many people as possible so they can also protect themselves. And I know a lot of you are frustrated because you're trying to tell people what you see and they go, la, 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 la. I don't want to hear it. But just send them that sound bite that we put up there from the FDIC laughing and saying, yeah, people will be bailed in. And there are different ways to bail you in. You can do it in an obvious way, but what do you think inflation is? They're robbing you. Why is that okay with you? It's not okay with me. That's what this protects you from. So even though one person can't do it, together as a community, we can make a positive difference. We have to come together. Constitutional sound money. We have to support that movement as a global community because we better have a seat at the table or we're just going to get more of the same. And actually, it'll even be worse, because it'll be a full surveillance economy. And what do you do when they say no? Nothing you can do. Food, water, energy security, barterability, wealth preservation, community and shelter. Community, local, global. That's what's going to save us. And until next we meet, please be safe out there. Bye-bye.